Okay, hi everyone. Let's take a look at this problem which deals with return on investment and economic value added. Alright, the problem appears in front of you and I'll read it. The balance sheet for the new product division of New Bone Corporation showed invested assets of $200,000 at the beginning of the year and $300,000 at the end of the year. During the year, the division's operating income was $12,500 on sales of $500,000. Okay, now below that short paragraph we have 4 requirements. Let's take a look at the first one. Compute the division's residual income if the desired return on investment is 6%. Okay, so let's just label this as number 1 here. And what we first need to write down is that the division's operating income was the number right above my mouse, $12,500. So I'm going to write that down. And then from there, we need to compute residual income if the desired return on investment is 6%. All right, well, we've got to compute the average assets. So let's label some of what these computations are. Okay, so this is operating income. Okay, so we'll put that right there. And then right next to operating income, we'll compute the average assets, right? Which was $300,000 at the end and $200,000 at the beginning. So we can type in equal $200,000 beginning plus $300,000 and divide that by 2. Okay, you guys all follow that, right? We come up with average assets of $250,000, and the required rate of return is 6%. So I'll just put that right there. And then if we want to compute residual income, we can do that right here. And what we will take is the $12,500 less the average assets, right, times the required rate of return. Okay, and if I've done that right, we come up with a negative residual income. Let me turn this so it shows up as red, or shows up in braces, or in parentheses anyway, as a negative $2,500. Okay, and that's the correct answer. Okay, let's take a look at number 2 now. Number 2 says, compute the following performance measures for the division: the profit margin, asset turnover, and return on investment. So let's take a look at a profit margin first. Okay, so profit margin, to compute that, we're going to take that same $12,500 of operating income, and then we need to divide it by the sales. All right, I'll just write sales here so we know what it is. Maybe it makes sense if I insert a row here so we can separate which goes with which. And the sales was equal to 500,000. Right, so if we wanted to compute profit margin, and this is operating income again, so I'll label that. And the profit margin is then equal to the 12.5 divided by the 500,000. We turn that into a percentage, maybe take it to 1 decimal point, and that's our answer. Why don't I bold the answers so we know which ones are the answers? Okay, then we got to take a look at 2b. Asks us to determine the asset turnover. So here it's asset turnover, and make some room again here. Let me quickly save this so I can make that painter go away. Okay, asset turnover, then we need to take sales divided by average assets, right? So now we're going to take this and move that here. Again, I'll put another insert line here. Sales divided by average assets, which we've already computed to be 250,000. And then we can copy in asset turnover, which is going to be equal to 500,000 in sales divided by the average assets, and that comes out to be 2 times, right? 2 times would be the correct way to state that. Okay, let's keep moving here, and we'll take care of 2C now, which is return on investment. All right, let's make some room here as well. I'll probably need a spot here to do this. Oh, and these I want to move to the right so it lines up right. Maybe we should slide up, give ourselves a little bit of room here. Return on investment, I'm going to abbreviate that just so it doesn't slide into the next cell there. Return on investment, we need to take that net income, which was the 12,500, or the operating income, I should say, and then we divide that by our investment, and the investment again is our average assets. And if we do that division, we come up with 5%. And put that in and I'll take it to 1 decimal point. Move that to the right. And that's our answer for part 2C. Okay, now what I've done is I've moved the screen so that we see the problem, but we'll have a little bit of screen real estate down below to work. So on number 3, we need to recompute the division's ROI under each of the following assumptions. Oh, and if I was going to make this consistent, that should look like that. Okay, so now under number 3, the first one, 3A, the first independent assumption is that sales increased to 500,000 to 600,000, causing operating income to rise from 12,500 to 30,000. So let's compute that operating income again. I'm just going to copy all of this, or excuse me. I'm going to copy right here, and then we'll work this one. Okay, so now operating, instead of becoming 12,500, it becomes 30,000. If I can type it in right, and average assets remains the same. So we see the impact is 12%. So we go from 5% to 12%. Okay, and that takes care of 3A. Now under 3B, I'll just copy this here. We invest assets at the beginning of the year are reduced from 200,000 to 100,000. Okay, but we're going to assume operating income was 12,500. So now instead of average assets being 200,000 plus 300,000 divided by 2, we're going to say it's equal to a beginning amount of 100,000 plus 300,000 divided by 2. So average assets drop to 200,000. And that shows us that return on investment goes to 6.3, or if I want to expand that a little bit more, it's 6.25. Okay, now under 3C it says recompute ROI assuming operating expenses are reduced, causing operating income to rise from 12,500 to 20,000. Okay, so we can copy the beginning ROI in there again, and I think the only thing we're going to change is that 12,500 goes to 20,000. Now, since Excel has the formulas out there, you'll see that the answer will immediately switch from 5% to 8, and that takes care of 3 A, B, and C. Let me move this one down so it lines up the right way. And let's take a look at number 4 now. 4 says compute. Oh, look at that, new bones. It's new bone. I used a voice activating software to get the text in there because I can speak quicker than I can type, and it sometimes doesn't get it perfect, so that's why I had to correct that for you. Okay, number 4 says compute the EVA. So let me write EVA down here. If total corporate assets are $500,000, current liabilities are $80,000, after-tax operating income is $50,000, the cost of capital is 8%. Okay, so now what we know is the ending result is operating income, right? Let's do this and delete that. Drop in operating income. And we'll drop in the 50,000 here. And then what we have to do is compute the economic value added. And in this case, they're saying the cost of capital is 8%. You know what? This one's going to look more like our first one. I think though I'm just going to lay it out the way they present it. So the cost of capital is 8%. So we'll put that in there. And then we need to consider what the investment base is. And the investment base is the 500,000 less the 80,000. So with economic value added, we need to consider what that investment is. And I'm going to call the net invested assets the investment base. Okay, that's probably a different term than our textbook uses. And that would be equal to the 500,000 less the $80,000. Okay, now once we have that in there, let me format that so it looks right, then we can compute EVA. And the way we would do that is we would take the $50,000 less the 8%, right, the cost of capital times the investment base. And that would compute an EVA, a positive number, of $16,400. So using economic value added, what that tells us is during this time period, the company actually contributed economic value added of $16,400 to the shareholders of the company who were expecting an 8% return. They actually did much better, and as a result of their actions, they had a $16,400 positive EVA. Okay, and that takes care of this problem, everyone. Let me slide back up so you can watch it or see the answers, right? I'll slowly slide down, and I'll thank you, everyone. Bye now.